Sharia products are, defined as such because they are Islamically tainted, if you will, in the way that there are some things that can't be sort of called Sharia if they are interest-bearing instruments, for instance. This is like the main topic. If the underlying assets are not Sharia compliant, or if you will, ethically acceptable from a Sharia standpoint. And the Sharia, perhaps we should start with this, is the definition basically of what is Islamically acceptable. Sharia law is not it's a concept, but it's also a way of interpreting Islam, the religion and the principle around Islam. And so you have a various school of thought around the Sharia application when it comes to Islamic finance, and depending on where you are in the region, you would have more or less, let's say, conservative application of the Sharia laws, and so you will see some instruments, for instance, being acceptable in Asia, Far East Asia, while they are not actually acceptable in the GCC. So it's quite important to sort of bear in mind that yes, you have a sort of set of constraints, or not constraints, but just guidelines as to what is ethically acceptable according to Islam and the Sharia law, and then what is the sort of interpretation of these laws depending on where you are in the world.
Okay. The Islamic finance industry contributes between 1 and 2% to total banking or total financial assets, and I think within the South African landscape, we are there and thereabout. If you take unlisted or unregulated investment funds that operate within the universe as well, and that number is around 100 billion, plus asset managers, plus banks, I think we're there and there about a 1% contributor to total assets under management.
Is it not difficult then to ensure that each underlying instrument in that Sharia portfolio is actually Sharia compliant effectively?
Yeah, so I just want to come back to what Mohammed was saying, and I totally agree with him. So we have a lot of clients who invest in our Sharia compliant products that are not Muslim because they believe in the underlying ethics. The way the products are structured is aligned to the ethical belief system. So earlier on, my colleague on the left mentioned that there are certain sectors that are not included in Sharia compliant products, such as alcohol, tobacco, gaming, pornography, arms, manufacturing, etc. And those type of beliefs are not just Muslim people that take up that belief system. So you find a lot of people investing in these products that are not actually Muslim people. If you go back to the global financial crisis of 2008, and if you see what happened at that point, it was because everything popped because of the over-leveraged economic system. People had too much debt on their books. The banks, the government, Fannie Mae, Freddie Mac, Lehman Brothers, all these guys were over-leveraged. Individuals, consumers in the US system were over-leveraged. Now, at that point, that's when Islamic finance really stood out relative to conventional finance, because it was totally unaffected at that point, because you wouldn't have had leverage in the system relative to conventional finance. And it's that excess of leverage that is really what is not acceptable within the Sharia compliance space.
I'd like to take out an Islamic loan interest-free. Do I just pay the capital back, or how exactly does it work in practice?
So I think it's a common misconception that people have, that when we say that the transactions or the instruments are interest-free, that the investors receive no return or there's no economic gain for the institution or the issuer. I think that's factually incorrect. What it means is, it goes back to some of the elementary understandings of what Sharia-compliant financial instruments are, is while money is not regarded as an asset, and so we cannot give out money and charge for the use of money in Sharia economic terms. And so you need to find another means in which to manufacture a margin. By, instead of referencing money as the subject matter of the contract, the actual underlying asset of the transaction is then referenced as the subject matter of the contract. And so the return is manufactured through that asset itself, rather than money being the asset of the transaction. So I think that, as an elementary view, creates the proper understanding that it doesn't mean, because it's a Sharia compliant instrument, there isn't any economic benefit. So that's the first thing. The second thing is from a pricing perspective, Samia mentioned it now, there isn't any augmentation of risk. It's the same risk lens that we apply to any of the transactions. There is still the same due diligence, the same prudence, the same principles that in any investment is applied to it. So what is a sukuk? Sukuk is a plural grammatically from the Arabic word which is known as sak. Sak means a unit of a bond or a piece of paper. It is the equivalent of a conventional bond. Now, when we say bond, that word is almost interchangeable within the conventional universe, where we say a bond is there to take out a home loan, a retail home loan, and a bond is also something that a sovereign would issue to raise capital. Within the Sharia universe, they are two very different things. A retail home loan isn't through a sukuk. A retail home loan is created through a different Sharia structure. A bond within the Sharia universe, or a sukuk, is the capital raising instrument that corporates, sovereigns, or state-owned enterprises would utilize to raise capital.